Question 1. Topic: Adverse selection in the context of casualty insurance. Adverse selection refers to which of the following scenarios: A. The tendency of high-risk individuals to seek or continue insurance coverage to a greater extent than low-risk individuals. B. The practice of insurers denying coverage to individuals who present a higher risk of loss. C. The concept that insurers must provide coverage for all applicants, regardless of risk level. D. The process of reinsuring high-risk policies to minimize exposure. Answer A. Explanation. Adverse selection occurs when individuals who are more likely to experience losses are also more likely to purchase or continue insurance. This concept is critical to risk management as it affects the insurer's ability to maintain a balanced risk pool. To counteract adverse selection, insurers may implement underwriting procedures to identify high-risk individuals and adjust premiums accordingly. Adverse selection does not imply denying coverage. Option B. Providing coverage regardless of risk. Option C. Or reinsuring policies. Option D. It strictly pertains to the higher likelihood of high-risk individuals seeking insurance. Question 2. Scenario-based. Topic: Comparative negligence in Kentucky. Mr. Stevens is involved in a car accident where both he and the other driver, Ms. Brown, were found to be at fault. Mr. Stevens was 60% responsible for the accident, while Ms. Brown was 40% responsible. If the total damages from the accident amount to $20,000, how much could Mr. Stevens recover under Kentucky's comparative negligence rule? A. $0. B. $8,000. C. $12,000. D. $20,000. Answer B. Explanation. Kentucky follows a pure comparative negligence rule where a party can recover damages even if they are partially at fault, but their recovery is reduced by their percentage of fault. In this case, Mr. Stevens is 60% at fault, so he can recover 40% of the damages, which corresponds to Ms. Brown's share of fault. 40% of $20,000 is $8,000. Options C and D are incorrect because they do not account for Mr. Stevens' share of fault, and option A is incorrect because Kentucky's comparative negligence allows partial recovery even if the claimant is more at fault than the other party. Question 3. Topic: Occurrence versus claims made forms in CGL policies. Which of the following best describes a key difference between an occurrence form and a claims-made form in a commercial general liability (CGL) policy? A. The occurrence form covers claims made during the policy period, regardless of when the event happened. B. The claims-made form covers events that occurred during the policy period, even if the claim is filed after the policy expires. C. The occurrence form covers events that happened during the policy period, even if the claim is filed after the policy expires. D. The claims-made form covers events that happened before the policy period, provided the claim is made during the policy period. Answer C. Explanation. The key distinction between an occurrence form and a claims-made form in CGL policies is the timing of the event and the claim. An occurrence form covers occurrences that happen during the policy period, even if the claim is made after the policy has expired, making C the correct answer. In contrast, a claims-made form requires that the claim be made during the policy period for coverage to apply, regardless of when the event occurred. Option A incorrectly describes a claims-made form, and option B misunderstands the limitations of a claims-made form. Option D is incorrect because claims-made forms typically exclude coverage for events occurring before the policy period unless prior acts coverage is purchased. Question 4. Topic: Vicarious liability. In Kentucky, under the concept of vicarious liability, which of the following scenarios is most likely to hold an employer legally responsible for the actions of their employee? A. An employee steals merchandise from a store on their own time. B. An employee gets into a fight with a coworker after work hours. C. An employee causes a car accident while making deliveries for the company. D. An employee causes a fire at home unrelated to their job duties. Answer C. Explanation. Vicarious liability refers to a situation where one party is held liable for the actions of another. In this case, the employer is held liable for the actions of the employee when the employee is acting within the scope of their employment. Option C describes a situation where the employee is performing work duties, delivering for the company, and causes a car accident, making the employer potentially liable. The other options describe actions that are outside the scope of employment, so the employer would not be liable under vicarious liability. Question 5. Scenario-based. Topic: Kentucky Personal Auto Policy (PAP). Uninsured motorist coverage. Sarah was involved in a hit-and-run accident where The other driver fled the scene and their identity is unknown. Sarah suffered bodily injuries and her vehicle sustained $15,000 in damages. She carries Kentucky Personal Auto Policy (PAP) with uninsured motorist coverage. What is the likely outcome regarding her coverage? A. Sarah's uninsured motorist coverage will not apply since the other driver's identity is unknown. B. Sarah's uninsured motorist coverage will apply for her bodily injuries, but not the vehicle damage. C. Sarah's uninsured motorist coverage will apply for both her bodily injuries and the vehicle damage. D. Sarah will only be covered if the other driver is identified and proven to be uninsured. Answer: C. Explanation. Under Kentucky's Personal Auto Policy (PAP), uninsured motorist coverage typically applies in situations where the at-fault driver is unidentified, as in a hit-and-run. Sarah can claim both bodily injuries and property damage under her uninsured motorist coverage. This coverage is designed to protect insured individuals when an uninsured driver or an unidentified driver, as in hit-and-run accidents, is involved. Option A is incorrect because uninsured motorist coverage specifically includes hit-and-run accidents. Option B is incorrect because the coverage can extend to vehicle damage depending on the policy. Option D is incorrect because the driver does not need to be identified. Question 6. Topic: Deductibles and coinsurance in casualty insurance. If a policyholder has a property loss of $10,000 and their policy includes a $2,000 deductible and 80% coinsurance requirement, how much will the insurance company pay, assuming the insured met the coinsurance requirement? A. $6,000. B. $8,000. C. $10,000. D. $7,000. Answer: B. Explanation. The insurance company will pay after the deductible is subtracted. In this case, the total loss is $10,000 and the deductible is $2,000. So the amount payable by the insurance company is $10,000. $2,000 equals $8,000. Since the insured has met the coinsurance requirement, there is no further reduction in the payout. Options A, C, and D are incorrect because they either misunderstand the effect of the deductible or coinsurance. Question 7. Topic: Bodily injury and property damage. Which of the following is NOT covered under the bodily injury and property damage liability portion of the standard Kentucky auto insurance policy? A. Medical bills for passengers injured in the insured's vehicle. B. Legal fees for a lawsuit filed by a pedestrian struck by the insured's vehicle. C. Damage to the insured's own vehicle during an accident. D. Compensation for property damage to a third party's fence hit by the insured's vehicle. Answer: C. Explanation. The bodily injury and property damage liability coverage protects the insured against claims from third parties, other drivers, passengers, pedestrians, for bodily injury or property damage. It does not cover damage to the insured's own vehicle, option C, which would be covered under collision or comprehensive coverage. Options A, B, and D correctly describe scenarios where bodily injury or property damage liability coverage would apply. Question 8. Topic: Punitive damages. Under Kentucky law, which of the following is the primary purpose of punitive damages in a liability case? A. To compensate the plaintiff for their injuries. B. To cover the plaintiff's legal fees. C. To punish the defendant for particularly egregious behavior. D. To reimburse the defendant for legal expenses incurred during the trial. Answer: C. Explanation. Punitive damages are awarded to punish the defendant for particularly reckless or egregious conduct and to deter similar future behavior. They are not intended to compensate the plaintiff directly for injuries. That is the role of compensatory damages. Options A and B relate to compensatory or legal damages, and option D is incorrect because punitive damages are not awarded to the defendant. Question 9. Scenario-based. Topic: Workers' compensation insurance in Kentucky. Mr. Davis, a construction worker, was injured on the job and is unable to work for 6 months. His employer carries Kentucky workers' compensation insurance. Which of the following benefits is Mr. Davis likely to receive under Kentucky workers' compensation laws? A. Full compensation for his lost wages. B. A percentage of his lost wages, plus medical expenses related to his injury. C. Only medical expenses related to his injury. D. Full coverage for his lost wages and future potential earnings. Answer: B. Explanation. Under Kentucky workers' compensation laws, an injured employee like Mr. Davis is typically entitled to receive a percentage of their lost wages, usually around 2/3 of their average weekly wage, and compensation for medical expenses related to the injury. Full compensation for lost wages, option A, or potential future earnings, option D, is not provided under workers' compensation. Option C is incorrect because lost wages are also typically compensated, not just medical expenses. Question 10. Topic: Insurance fraud regulations in Kentucky. Which of the following is considered insurance fraud under Kentucky law? A policyholder failing to notify the insurer about a minor accident that does not result in a claim. B. A policyholder exaggerating the value of lost property in a theft claim. C. An insurance agent quoting premiums from multiple companies. D. An insurer denying a claim based on exclusions in the policy. Answer: B. Explanation: Insurance fraud in Kentucky occurs when a policyholder knowingly submits false or exaggerated information to an insurer to receive undue benefits. Exaggerating the value of a claim, as in option B, is a clear example of fraud. Option A is not considered fraud if no claim is made, and options C and D are normal business practices for agents and insurers, respectively. Question 11. Topic: Comparative negligence in Kentucky tort law. In Kentucky, if a plaintiff is found to be 30% at fault in a tort case and the total damages amount to $100,000, how much will the plaintiff receive under Kentucky's comparative negligence laws? A. $100,000. B. $70,000. C. $50,000. D. $30,000. Answer: B. Explanation: Kentucky follows the pure comparative negligence rule, which means the plaintiff's recovery is reduced by their percentage of fault. If the plaintiff is found to be 30% at fault, their recovery will be reduced by 30%, leaving them with 70% of the damages. Therefore, they will receive $100,000 times 0.7 equals $70,000. Options C and D misunderstand how comparative negligence applies to damages. Question 12. Scenario-based. Topic: Commercial general liability. For occurrence versus claims made forms. Mr. Thompson, a business owner, had a commercial general liability (CGL) policy that was on a claims made basis. 2 months after the policy expired, a customer filed a lawsuit for a slip and fall injury that occurred during the policy period. Will Mr. Thompson's insurance cover the claim? A. Yes, because the injury occurred during the policy period. B. No, because the claim was made after the policy expired. C. Yes, if Mr. Thompson had tail coverage extended reporting period. D. No, because slip and fall injuries are not covered under CGL policies. Answer: C. Explanation: A claims made policy only covers claims that are both made and reported during the policy period, unless an extended reporting period or tail coverage has been purchased. Since the claim was made after the policy expired, the claim would not be covered unless Mr. Thompson had purchased tail coverage. Option A is incorrect because the timing of the claim, not the injury, is what matters in claims made policies. Option B is only partially correct, and option D is incorrect because slip and fall injuries are generally covered under CGL policies. Question 13. Topic: Kentucky workers' compensation benefits and claims process. In Kentucky, which of the following is a key requirement for an employee to qualify for workers' compensation benefits? A. The injury must have occurred while the employee was traveling to work. B. The injury must occur during the course of employment and within the scope of job duties. C. The employee must prove that the employer was at fault. D. The employee must be on probation for workers' compensation benefits to apply. Answer: B. Explanation: For workers' compensation benefits to apply, the injury must have occurred in the course and scope of employment. It does not matter whether the employer was at fault, as workers' compensation is a no-fault system, making option C incorrect. Option A is generally not covered because injuries that occur while commuting to or from work are often excluded unless the employee is performing work-related duties. Option D is irrelevant because benefits apply to all covered employees, regardless of probationary status. Question 14. Topic: Commercial auto insurance. Garage keepers coverage in Kentucky is designed to protect businesses that store customer vehicles. Which of the following losses would most likely be covered under this policy? A. A customer's vehicle is damaged by a fire while in the shop's care. B. The shop's tow truck is involved in an accident and damaged. C. An employee's personal vehicle is stolen from the shop's parking lot. D. A customer's vehicle is damaged due to poor repairs done by the shop. Answer: A. Explanation: Garage keepers coverage provides protection for customer vehicles while they are in the care, custody, and control of the business. Option A, where a customer's vehicle is damaged by fire, would be covered. Option B is incorrect because garage keepers coverage applies to customer vehicles, not business-owned vehicles. Option C is incorrect as the coverage does not extend to employee vehicles. Option D involves liability related to poor work, which is usually covered under other forms of liability insurance, not garage keepers coverage. Question 15. Topic: Insurance fraud regulations in Kentucky. Which of the following is an example of insurance fraud under Kentucky law? A. An insured person accidentally forgets to include a small repair bill in their claim. B. An insured person deliberately inflates the value of a claim to receive a higher payout. C. An insurer denies a claim because it falls under a valid policy exclusion. D. An insured agent provides the client with multiple quotes from different insurers. Answer: B. Explanation. Deliberately inflating the value of a claim to receive a higher payout constitutes insurance fraud in Kentucky. It involves the intentional misrepresentation of facts to the insurer. Option A is incorrect, because an accidental oversight does not typically constitute fraud, though it should be corrected. Option C is a legitimate business practice, and option D is standard practice for agents and brokers providing comparative quotes. Question 16, scenario-based. Topic: Liability insurance. Legal liability. Mr. Reynolds owns a small business in Kentucky. One of his employees inadvertently damages a client's expensive equipment while performing a repair. The client sues Mr. Reynolds for the damage. What type of insurance will provide coverage for the lawsuit and any compensation that must be paid to the client? A. Workers' compensation insurance. B. Commercial auto insurance. C. Commercial general liability (CGL) insurance. D. Personal liability insurance. Answer: C. Explanation. Commercial general liability (CGL) insurance covers claims related to property damage or bodily injury caused by the business or its employees during the course of business operations. In this case, the damaged equipment is a property damage claim, and CGL insurance will cover both the legal costs and compensation. Workers' compensation, option A, covers employee injuries, not client property damage. Option B is incorrect, because commercial auto insurance only covers vehicle-related incidents. Option D is irrelevant, as personal liability insurance does not cover business activities. Question 17. Topic: Kentucky Personal Auto Policy (PAP). No-fault insurance. Under Kentucky's no-fault insurance system, what is the primary role of personal injury protection (PIP) coverage? A. To provide coverage for bodily injury to the at-fault driver in an accident. B. To provide compensation to drivers for damage to their own vehicles. C. To cover the medical expenses and lost wages of the insured regardless of fault in an accident. D. To cover liability claims from third parties injured in an accident. Answer: C. Explanation. Kentucky operates under a no-fault insurance system where personal injury protection (PIP) coverage is designed to cover the insured's medical expenses, lost wages, and other out-of-pocket costs, regardless of who caused the accident. Option A is incorrect, because PIP does not specifically address the at-fault driver. Option B is incorrect, as vehicle damage is covered under collision coverage. Option D relates to liability coverage, not PIP. Question 18. Topic: Unfair claims settlement practices. Which of the following would likely be considered an unfair claims settlement practice under Kentucky law? A. The insurer promptly investigates a claim before denying it. B. The insurer delays the investigation of a claim without reasonable justification. C. The insurer denies a claim based on a valid policy exclusion. D. The insurer offers a settlement that is lower than the requested amount with an explanation. Answer: B. Explanation. Kentucky law prohibits insurers from engaging in unfair claims settlement practices, which include delaying the investigation or settlement of a claim without a valid reason. Option B would likely be considered an unfair practice. Option A describes appropriate conduct, as a thorough investigation is necessary before a claim is denied. Option C is a valid reason for denial if based on policy terms, and option D is acceptable if a reasonable explanation is provided for the lower settlement offer. Question 19. Topic: Cyber liability insurance. In Kentucky, which of the following situations would typically be covered by a cyber liability insurance policy? A. A hacker steals customer credit card information from a business's database. B. An employee damages a company's server during maintenance. C. A company's products are recalled due to a safety defect. D. A client sues a company for breach of contract. Answer: A. Explanation. Cyber liability insurance provides coverage for data breaches and cyber attacks, including incidents where sensitive information such as customer credit card data is stolen by hackers. Option A is a classic example of what cyber liability insurance is intended to cover. Options B, C, and D relate to other types of insurance, such as property insurance, product liability, and errors and omissions EO insurance, respectively. Question 20. Topic: Control business and rebasing. In Kentucky, which of the following practices is prohibited under the regulations governing control business? A. Selling insurance to family members as a primary source of income. B. Offering a discount on premiums to long-term customers. C. Selling more than 50% of an agent's total business to family members or businesses the agent controls. D. Referring potential clients to another insurance agent. Answer: C. Explanation. Control business refers to the sale of insurance policies primarily to an agent's own family members or businesses the agent controls. Kentucky law prohibits agents from conducting more than 50% of their total business with controlled entities, as this creates the conflict of interest and undermines the integrity of the insurance market. Option A may be acceptable in limited cases, but not as the primary source of business. Option B refers to rebating, which is a different practice. Option D is not related to controlled business and is an acceptable practice. Question 21. Topic: Kentucky property insurance. Replacement cost versus actual cash value. Which of the following best describes how actual cash value (SCV) is calculated under a Kentucky homeowner's insurance policy? A. The cost to replace the item with a new one minus depreciation. B. The cost to replace the item with a new one with no depreciation considered. C. The amount originally paid for the item. D. The fair market value at the time of the insurance purchase. Answer A. Explanation. Actual cash value (SCV) is calculated as the replacement cost of an item minus its depreciation. This means that the value of an insured item is reduced based on its age and condition at the time of loss. Option B refers to replacement cost coverage, which does not account for depreciation. Option C and D are incorrect because the original purchase price or market value at the time of policy issuance is not used in calculating ACV. Question 22. Scenario-based. Topic: Business owners policy. Equipment breakdown coverage. A small business owner in Kentucky experiences a loss when their commercial refrigeration unit suddenly breaks down, leading to spoiled inventory worth $5,000. The business has a business owner's policy (BOP) with equipment breakdown coverage. What will the BOP likely cover? A. Only the cost to repair or replace the refrigeration unit. B. The cost to repair the refrigeration unit and the value of the spoiled inventory. C. The value of the spoiled inventory only. D. The business's lost income due to the breakdown, but not the equipment or inventory. Answer B. Explanation. Equipment breakdown coverage typically pays for both the repair or replacement of the broken equipment and any direct losses, such as spoiled inventory, resulting from the breakdown. Option A is too limited as it ignores the inventory loss, and Option C only considers the inventory. Option D misrepresents the scope of the coverage, as it usually covers more than lost income. Question 23. Topic: Kentucky auto insurance. Uninsured motorist coverage. Uninsured motorist coverage in Kentucky is designed to protect policyholders in which of the following scenarios? A. The policyholder causes an accident and the other driver has no insurance. B. The policyholder is hit by a driver without insurance or by a hit-and-run driver. C. The policyholder is involved in a multi-car accident with minor damages. D. The policyholder has full coverage and opts out of coverage. Answer B. Explanation. Uninsured motorist coverage protects the policyholder in situations where they are injured or their vehicle is damaged by a driver who either has no insurance or flees the scene hit and run. Option A is incorrect because coverage does not apply when the policyholder is at fault. Option C doesn't specify that the other driver was uninsured, and Option D ignores that coverage can be waived by the policyholder but doesn't apply here. Question 24. Topic: Insurance licensing in Kentucky. In Kentucky, which of the following is a requirement for an individual to obtain a resident insurance producer license? A. The individual must be at least 25 years old. B. The individual must complete pre-licensing education requirements and pass the state exam. C. The individual must work for an insurance company before obtaining a license. D. The individual must hold a law degree. Answer B. Explanation. To obtain an insurance producer license in Kentucky, The individual must complete pre-licensing education and pass the required state examination. There is no requirement to be 25 years old, option A, work for an insurance company, option C, or hold a law degree, option D. Question 25. Topic: Commercial property insurance. Coinsurance clause. A Kentucky business owner insures their property for $200,000, but the policy contains an 80% coinsurance clause. The property is valued at $300,000. If the business experiences a partial loss of $60,000, how much will the insurer pay, assuming no deductible? A. $48,000. B. $60,000. C. $40,000. D. $30,000. Answer A. Explanation. With an 80% coinsurance requirement, the business should insure at least 80% of the property's value, which in this case is $300,000 x 0.A equals $140,000. Since the owner insured the property for only $200,000, they are underinsured. The amount the insurer will pay is determined by the formula amount insured required insurance clause payout. So 200,000 to 140,000 x 60,000 equals 50,000 x 0.8 equals 48,000. Therefore, the insurer will pay $48,000. Question 26. Topic: Kentucky dwelling policy. Deeper 2 broad form. Under Kentucky dwelling policy Deeper 2 broad form, which of the following perils is covered? A. Flood. B. Earthquake. C. Falling objects. D. Intentional damage by the insured. Answer C. Explanation. The Deeper 2 broad form covers specific named perils, including falling objects, fire, windstorm, hail, and more. Option A. Flood and option B. Earthquake are generally not covered unless additional endorsements are purchased. Option D is excluded, as intentional damage by the insured is never covered under standard policies. Question 27. Topic: Subrogation. Subrogation refers to A. An insurer seeking reimbursement from the policyholder for a claim. B. A third party taking over the insured's claim. C. The transfer of the insured's rights to the insurer after a claim payment. D. The cancellation of a policy before its expiration. Answer C. Explanation. Subrogation occurs when the insurer, after paying a claim to the insured, seeks reimbursement from the party at fault by stepping into the insured's shoes and asserting the insured's legal rights. Option A confuses subrogation with an unrelated concept. Option B misinterprets third-party involvement, and option D refers to cancellation, which is unrelated to subrogation. Question 20. Topic: Kentucky property insurance. Vacant property clause. In Kentucky, how does a standard property insurance policy typically address losses when a property has been vacant for over 60 days? A. Coverage is voided entirely for all losses. B. Coverage is reduced or eliminated for certain types of losses. C. Coverage remains unchanged. D. Coverage is doubled due to the increased risk. Answer B. Explanation. When a property is vacant for more than 60 days, most standard property insurance policies reduce or eliminate coverage for certain types of losses, such as vandalism, water damage, and theft. The coverage is not voided entirely, option A, and there is no increase in coverage, option D. Question 29. Topic: Kentucky workers' compensation insurance. Which of the following is true regarding Kentucky workers' compensation insurance? A. Is optional for all employers, regardless of the number of employees. B. It provides wage replacement and medical benefits for employees injured in the course of employment. C. It only applies to businesses with more than 50 employees. D. It does not cover illnesses related to workplace exposure. Answer B. Explanation. Kentucky workers' compensation insurance provides wage replacement and medical benefits to employees who suffer job-related injuries or illnesses. Employers are generally required to carry this insurance if they have one or more employees, with some exceptions. Option A is incorrect because workers' compensation is mandatory for most employers, and option C misstates the employee threshold. Option D is incorrect because illnesses related to workplace exposure are covered under workers' compensation. Question 30. Topic: Kentucky homeowners insurance. Water backup coverage. Which of the following is typically covered by an endorsement for water backup in a Kentucky homeowners insurance policy? A. Flood damage. B. Overflow of a sump pump. C. Damage from a burst pipe. D. Surface water entering the home. Answer B. Explanation. A water backup endorsement typically covers damage caused by the overflow or backup of sewers or some pumps, flood damage, option A, and surface water, option D, are not covered under standard homeowners policies and require separate flood insurance. Option C is generally covered under the base policy for water damage caused by burst pipes, making it different from water backup coverage.